So welcome back. This has been a very stimulating afternoon and a stimulating morning, and we now have a very exciting group, and it is my pleasure to ask Jeff Dennis to moderate this conversation. To give you a little background, Jeff is Fasken Martineau's entrepreneur in residence. He is a lawyer, serial entrepreneur, public speaker, and best-selling author. Jeff works with fast-growing entrepreneurial companies, assisting them with strategy and finance. He co-founded the Toronto chapter of Young Entrepreneurs Organization, now called Entrepreneurs Organization. And through his associations with Entrepreneurs Organization and the Ewing Marion Kaufman Foundation, he co-authored a book entitled Lessons from the Edge, in which entrepreneurs share their worst mistakes in business and the lessons that they learned. Ladies and gentlemen, it gives me great pleasure to introduce Mr. Jeff Dennis. Thank you.
Well, thanks for staying. You're going to be rewarded because, as always, we save the best for last. We have a really interesting panel here. We're going to be focusing on the relationships between private equity managers and their investee companies. And we're going to talk a little bit about what investors should look for as through the lens of this relationship that you're going to see unfold here. We're very fortunate to have a very interesting panel. We have people representing, as I said, both sides of the street, both managers and CEOs. Rosenthal, he's the managing partner of Imperial Capital, which was founded in 1989. Imperial Capital is a Toronto-based private equity fund manager that focuses on buyout opportunities in the Canadian and American mid-market, enterprise values between 50 and 150 million. Next on our roster, we have Anthony Siegel. Anthony is the president and managing partner of Kilmer Capital Partners Limited. Kilmer Partners is a leader in making private equity investments in small to mid-sized businesses undergoing periods of rapid growth, significant change, or ownership transition. We have Lou Michael Barbudo. Lou is the founder, president, and CEO of AIM Health Group. AIM is an integrated health care service provider which Imperial Capital acquired in October of 2011. Is that right? So far, so good? Prior to that, AIM was a public company trading on the Toronto Venture Exchange. And then finally, we have Chris Perkins, who's the CEO of, and I want to get the pronunciation, I hear it's AlgoFarm, or Algorithm Farm Holdings, which was founded in 1992 and is a Montreal-based company that specializes in clinical trials and bioanalysis. In 2007, Kilmer Partners acquired a majority interest in AlgoFarm, and Chris has been there, I believe, since 2010. So with that, what I'm going to do is ask each one of our panelists to come forward and give us their elevator pitch, a couple minutes about who they are, what they're looking for, and then we'll get into the relationship. So why don't we start with you, Jeff?
Imperial Capital is a Toronto-based private equity company. We take controlling interests in profitable lower mid-market companies, typically that have EBITDAs between 5 and 15 million. We tend to invest in and acquire either family-owned businesses or entrepreneurially run businesses in the healthcare services space, branded consumer non-durables such as food, and business services. And we're really quite focused in particular niches within each of those that offer necessity-type products and services and relative stability around the growth trend line. We've been around for a large number of years, I think now about 23 years in terms of principal investing. We're currently investing out of our fifth fund, which is a $300 million fund and slated to close to investors over the next 4 weeks, so there's still time. We're different than many of our peers in a couple of regards. Probably the most obvious is that unlike many of our peers, we are funded primarily by investment from high net worth individual investors. So out of the 300 million that will be raised in Fund 5, about 260 million of that is actually high net worth money, with the remaining 40 million from institutional type investors. We invest in both Canada and the US, and across the spectrum of the types of companies in which we invest, we tend to see the same things over and over again. These are companies that are very good at producing the products they produce or providing the services they provide, but they generally have a lot of gaps in everything else they do. And so our job is to bring that toolkit to the table and help get them from the level they're at to the next level, which, absent the external resources that we bring to bear, they'd have a very difficult time doing. So that's what we've been doing for the last 20 plus years.
Anthony, why don't you go next?
I get asked to do this fairly frequently, and I always, in leading up to it, ask myself, what was the inflection point at which somewhere in my life people wanted to hear what I actually had to say? And I still wonder when that will be, because when I listen to my partner here, and when you listen to him speak later, I think you'll realize he's got a lot more interesting things to say than I do about the business that he runs for us. But in any event, Kilmer Capital was started in 1994. We have offices in Toronto and in Montreal. We focus on both growth investments and buyout investments in the Canadian and mid-market. What we mean by that is the company would have revenues between, say, $50 and $150 million at the time we encounter the company. And the opportunity often arises, as Jeff said, through as a result of the owner deciding to retire. Perhaps there's been a dislocation in a partnership whereby one partner needs to buy out another partner. There may be a need for the beginning thoughts on wealth diversification, wherein we would buy a stake in the business with a plan to buy more of the business over time as the owner-operator looks to retire. And finally, there could be an instance where capital is needed to fund some form of expansion of the business, buy a competitor, expand a plant, something along those lines where we'd come into the business. We really like niche businesses that operate within large industries. We like the large industries because it creates a lot of room to maneuver for our business plans. And we like the niches because that's typically where we can find good growth. We then look to validate the opportunity to scale that business by introducing capital, our network, great management, and various other forms of expertise we can bring to the table. And we have to validate that just because the business exists and someone may be willing to allow us to invest, it doesn't mean that this $50 million business has the capability of even growing to $100 million. So we have to validate that the whole plan can actually happen, assuming you put the right management and the right capital team in place. We also tend to focus on business services, consumer brands, healthcare, and business products and building products and services. The Kilmer organization has a deep history in this city in and around construction, and so we have a lot of knowledge within our organization on construction. We tend to stick to those industries because it's our world, and we may talk about this later in the panel, but our world has become increasingly, the industry's matured. And as a result, competition has gotten more intense, and so we compete better when we stick to situations that we know best, and we feel we can make smart decisions quicker than other people, or we can see value where other people may not see that value if they haven't ever invested in the industry before. Some of the more familiar companies we either owned or do own today that you might be familiar with. We own a company called Give and Go Bakery, which manufactured the 2-Bite Brownie and a range of bakery products under a 2-Bite brand, grew the company significantly through most of the 2000s. We own a company today based in Montreal, in addition to Chris's, called Lole, which is a very fast-growing, high-end performance female apparel company, fully branded. We own a company today that has a sole contract to build out rental services. They run a rental services agreement for Home Depot at Home Depot. And so we've started in about 50 locations about a year and a half ago, and we're now at 1,000 Home Depot locations across North America, renting mobile equipment out of their parking lots. So we look for sort of unique situations where there's an opportunity to scale under a great management team.
So next we're going to hear from Lou.
Am I answering the question?
The question is, who are you and what do you do?
All right. I am was the CEO of, and you notice the little guy gets pushed to the end, right? My rebuttal to that is they can't fit in Ferraris and they can't sail a sloop. We have completed a transaction in May of this year where we sold AIM Health Group, and I'll get into it in another area, but Healthcare is a fairly complicated organization or set of businesses in Canada, is that it's constantly changing. Very few people understand what healthcare really does in the Canadian marketplace. When I first got into this business in 1990, probably 4 to 8 cents on the dollar were invested from the private sector into healthcare. It's now about 33 cents on the dollar. And when I speak to deputy ministers, politicians, they still have a hard time defining what it is who funds healthcare. And in Canada, it goes through various different portfolios or ministries. So there's a lot of money that's in healthcare, and we can talk about that a little later. But my job was to create what's referred to as a multidisciplinary primary care environment, so that when you went in to see your family doctor, that's covered by the Medicare system, the OHIP, or whatever province you're in. But then there's cross-collateral referral into privatization or private funding. And so the concept was that we developed an organization whereby all the different levels of funding supported not just the treatment of an illness, but the prevention and the management of the wellness. And we took that, we went through quite a bit of a turn, because every 2-3 years healthcare changes. There's different legislations, the feds change their ideas, the provinces change their ideas, and then different companies and insurance companies are also involved, also alter their strategy. But we developed it to a considerable size, with about 900 employees and close to a run rate of 70 million, and it would be considered as the largest primary care in Canada at that time of sale.
Great. So Chris, you're up.
Sure. Well, I can probably summarize my position as I'm that Thanksgiving turkey that's been referred to throughout the presentations. I build businesses. I built businesses since 1975 in the early drug development sector, either before it gets to the clinic or afterwards. So since 2010, I've been working with Algorithm Pharma, which is based out of Montreal, as the CEO, and that's a company that does early stage clinical studies for a wide range. A CRO just means that our services are for hire by any company that wants to use them. Algorithm was focused mainly on the generic industry during the golden years of the generics. We all know that the patent cliff hit. The generics have changed. In conjunction with Kilmer and discussion, we realized in 2012 that the generic industry was not sustainable. So we went ahead and we acquired another company in Kansas which focuses on the disease states. Well, the disease states, well, it's the diseases that walk amongst us. It's the hypercholesterolemia, high blood pressure, diabetes, early Alzheimer's, Parkinson's, where all the new drugs that are coming out have been targeted, the problems of the aging baby boomers. So we've now got a very good portfolio. Most of the concentration at the moment is on integrating it and matching the business. The industry has changed tremendously. The way drugs are developed and the amount of money spent to develop a drug and put it on the market is very different now to what it was 8-9 years ago. We're also seeing a lot of the generic drugs being reformulated, put together in packages. So instead of taking 4 tablets, you take 1. Instead of taking it by oral or at intravenous, you take it by transdermal patches. So I think it's a market that's got a tremendous potential for growth. It's the way that it's the direction drug development is going, but because it's early stages, it's not an easy one to manage. I spend most of my days trying to predict where the market's going to go to ensure that we've got the right mix of capabilities for the right clients and to integrate the two companies.
So we heard from the managers a little bit about what they're looking for, what the investment criteria is, and I hope during the conversation we can drill down a little bit on that. But I'd like to ask each one of you in turn, what do you think are the key characteristics of a successful relationship between the fund manager and the company, the CEO, and the team? Lou, do you want to start?
Sure. So that's an excellent question, obviously, and I'm not aware of any empirical data or studies that have guided me through the years to tell me what characteristics will lead to good corporate governance or performance. I rely on a fairly basic, and always have relied on a fairly basic philosophy, and that's chemistry, What I mean by that, there has to be synergistic qualities that come together immediately. It's the concept of first love, right? First sight, first love. Number two is communication, and number
So is that, sorry to interrupt, but is that about people, or is it about business
It's about
synergy?
the fund managers. When we get together, when we decided to privatize the company, we had probably one of the largest collection of fund managers from private and public equities that came to our door. And I'll never forget this. My CFO comes in, and this must have been the 12th, 13th, 11th private equity company that came to our table. I think Imperial was the last. And I was sort of fairly busy, walked into the boardroom and said, okay, guys, you've got 5 minutes to get my attention. And the chemistry was right there. Their knowledge base was incredible. And I let them talk. And then I started to drill down and say, okay, there's 3 big deals that just went down. Talk to me about healthcare deals. What was the structure? Why would they invest in it? That sort of thing. And they knew all the information. So right away I thought, here's a group that's knowledgeable. The chemistry's there. The communication was very clear. And more important, because of the business of healthcare, it's probably more difficult than politics. The trust factor had to be there. And my thoughts and reasoning behind that are as follows. Let's assume that most private equity firms and come in, do their due diligence. They've crossed their T's, dotted their I's. Everything's copacetic, and presumably they've come to the conclusion that this is a good investment. Otherwise, they wouldn't be there. Most people have those talents. They can come, do the math, look at past numbers, and try and predict where it's going to go. The difficulty comes when there's either external or internal changes happen. Legislation comes into play, and as I said earlier, there's 3 ministries that control healthcare in our province, the Ministry of Health, the Ministry of Labor, and Ministry of Finance. So when things change, whether externally or internally, the gloves may not come on because you're still in the honeymoon period, but the mitts are on. And at that point, you have to rely on that synergistic chemistry and the trust that, look, we're going to change direction. This is where we're going to go. And, you can't rely on past numbers now. And so now that really gets into the communication, the ability to communicate effectively. And that's why those were the things that mattered to me. And so far, they've been successful in my career.
Terrific. Jeff, maybe you'll share the mirror image of that.
Sure. For us, making an investment in a really small cap private company is like getting married. And that investment decision is one that you're going to have to live with for some period of time, through good and bad. It's never a straight line up, even though your forecast might indicate that way. And it always comes back to the quality of the people that you're getting into bed with and the type of relationship that you have. So as it pertains to the CEO-PE manager relationship, trust is critical. And trust, we look at it from a capability, an ethics, and an accountability perspective, all of which are critically important. For us, alignment of interests, both short and long-term, economic as well as lifestyle, become critically important, and a clear and honest understanding put on the table by both parties really drives value. We don't want to create the vision for a business. We want to buy into the CEO's vision for what he or she can do, and then support that vision with the resources that we bring to bear and help in that execution, whether they're financial resources or human resources or our network out there. So for us, it begins with strategic planning, which rolls down into a budgeting process and really a management by objectives process, which we can all sign on to. It's measurable. We have clear deliverables. There's an alignment of interest. And, I guess the other characteristic I would say is that there's a careful line between overstepping your bounds as an investor during good times and bad. We don't want to micromanage business. It's very hard to hold somebody accountable as CEO if you were in there every day making all the small decisions. So we give people a fair degree of room to run their business, and that comes back to the trust factor.
Great, thank you. Anthony?
I totally get the marriage analogy. If you're planning on having your marriage only last 5 years, and if you think that an 8-year marriage means you've been getting a little long in the tooth, because that's what private equity is all about. But I get everything else you're saying about a marriage. Because similarly, like my notes to myself said, to make any relationship work, we have to, the relationship has to be founded in trust and respect, and it has to be founded in a willingness on both parties to have open two-way communication about the good and the bad, and that has to be sort of the foundation of the way in which we're going to work together for the period of time that we're going to try and create value together. And when we move beyond that, I think it's imperative that there are very clearly articulated goals that both of us have bought into and both of us see as achievable. And then we'll create financial alignment around those goals in the form of direct equity ownership, compounded by an option, long-term option plan. And we structure those plans in such a way that to the extent the investor, me, does well, Chris and his team should do super well on a proportionate basis. And we also then sit down and spend a fair bit of time, as Jeff alluded to, in a planning process, 100-day planning process, budgeting process, rolling 3-year planning process, setting expectations from both parties, and getting consensus as to what can be achieved over what period of time, followed by an agreed-to set of rigorous, regular reporting / discussion meetings whereby we assess the progress we're making against our plans, whereby setbacks against those plans are discussed openly, strategies to get over those hurdles are agreed to or discussed openly, and then you just keep moving forward.
Chris?
I concur with everything Anthony says, and it's easy to say those things, but it's extremely difficult to actually live them, because what's true in business is nothing ever goes according to plan. What we say is, well, we've got every year, we say we've got the budget. Yeah, we'll make those numbers, but I guarantee you the way we make those numbers is not how we're intending to do it at the beginning of the year. So there's always ups and downs. So it's okay saying that when you go into the relationship, but it's whether you're going to live it throughout the relationship year after year. And I think that's very important. I came in 2010, when I came to talk to Kilmer, I was looking for another opportunity. I came very jaded from investor groups. I came to Canada in '88, and I stayed at the same company for 22 years. During those, from 1989 to 2004, we had 6 different owners, of which 4 of them were some sort of investor. None of those 4 were a pleasurable experience. All of them were characterized, remember this was the 90s as well, all of them were characterized by taking as much cash out as possible, putting the minimum investment in possible, and flipping it as quickly as possible for the maximum amount of money. Not really there to create a good relationship between the manager and the investor. I always remember a second investor, probably about 93, 94, came in, we'd never met them before, met with the management team. His first slide was a cartoon drawing of a man, obviously a worker, in a wine press that was crushing him down. And the caption underneath was, "Thank you, sir, please just one more turn." And I think that pretty much characterized the relationship. So I'd come out, when I was looking around for opportunities, I said, I do not want any investor-owned company at all. I was looking more for owner-run companies. But I was persuaded to meet with Kilmer, and what I was really impressed with was not what they did, but it was what they didn't do. And I think that's probably based upon history, and that they didn't immediately state what was expected. They didn't look for an early commitment to the deliverables, like, what can you do? I want you to do this. They didn't demand commitment to personal investment up front. It was more of a general business discussion. What do you think the issues are with the business? They shared information with me before the first meeting. There was a trust before we'd even sat around the table. So we were able to have a business discussion of where do you think it can go? Why? What do you think the hurdles are? What are the barriers? What do you need? And that went on that was the first of 3 of that type of meetings. And when we agreed that yes, there was a synergy, there was a chemistry there wasn't really much commitment. There was no commitment to a deliverable other than to prepare a plan. There was a commitment, though, that we both believed it could grow, and Kilmer committed to put in what was necessary in the support to help it grow, and my commitment is to put in the management and the operations experience to to get it where we need it to be. We created a strat plan. I think any manager, investor getting together, you've got to have a commitment for a strat plan. It's the roadmap. 5-year strat plan, sure, but anything beyond 3 years is semi-speculative. But having that plan that's achievable, that you both agree, removes a lot of the concerns. Being able to share issues, regular meetings, don't just meet with them every 3 months. We talk every month on a defined meeting for at least 2 hours. We review what's coming up, what's gone wrong, what's gone right, what are the issues. It's just a very good relationship where we're both obviously on the same side.
Lou, is yours a regular monthly meeting too, or is it more often, less often? What does that look like from your perspective?
Ours is monthly. You know, the added value that I looked for outside of the trust, communication, and chemistry thing was that obviously it's understood that there's going to be a certain amount of knowledge base that can support the strategy of the company. In our particular scenario, I was pretty impressed on the drilling because I had PE companies that came to me and they looked at numbers and they thought, well, this is a good investment. I agree with, you know, what you were just saying, getting in, getting out, and making money. I found Imperial a little different, and they bought into the strategy, which happened to be successful, touch wood, and that under the care, under the direction, there were new biologics that were coming into play in medicine on complex disease, things like ulcerative colitis, Crohn's disease, rheumatoid arthritis, lupus, MS, and we moved quickly into that area. But we were too small, really. A company that in that size really needs a lot of expertise. And so at times it would be regular reporting, once a month, quarterly reviews, but at times it literally was day to day. I required so much support in these biologics, and we kept winning a lot of the contracts, that I really needed analysis.
Was that because you were asking for the help, or they were worried that you needed the help?
I'd like to think I was asking. No, I was asking for the help. That was part of the strategy at the beginning. They had to trust me that we were going in the right direction. And it was a very, very complex set of transactions in the past 5-6 years before Imperial came to privatize it. But the strategy obviously worked, and you know, I can't overemphasize the complexity of the advent of new molecules. It's about a $5 billion business that was coming down in the next 5 or 6 years, and it's a new form of treatment. 66% of these meds have to be administered, and so you have to have supervision. And so patients would come to the centers and they'd sit there for 3 hours. And another add-on that in terms of, you know, is it monthly reporting or is it quarterly reporting? They put somebody on the board who very, very knowledgeable intensivist and background in obviously in medicine research and had a MBA and worked with McKinsey. So that helped me a lot. So I worked with David Klein very closely in terms of strategizing on a lot of these molecules and biologics, and how we would form a national chain for. So it's really, I don't think it would be a typical relationship that you would look at where, you know, you submit reports every month. Would you agree?
I don't think there is a typical relationship.
Jeff, they can't hear you.
I don't think there is a typical relationship in companies of this size. You know, we're buying companies as platforms for growth, both organically as well as through follow-on acquisition. So each situation is different, different dynamics, different marketplaces, and you know, when you have willing parties on both sides and that mutuality of vision and trust, the reporting relationship becomes what it has to be.
Chris, we heard earlier about this 5 to 8 year time horizon. How does that factor into your strategy and decision making? I mean, do you feel the pressure, you know, 4 to 6 years out or 4 to 7 years out that, you know, we're going to go have to find a new investor, change the business, sell the business, go public or something? I mean, how does that factor into your thought process at all?
It doesn't factor in on a day-to-day basis. We have a 5-year strat plan. We know we're going to be in 5 years. The relationship we have with Kilmer is that it's shared. We know that when they're going to start looking, what they want to look at, we've agreed that we will work on it together. So it's not going to be a, who's that coming to the door today? I don't anticipate it being sold without my knowledge. I don't anticipate it being put up for sale without my knowledge. I mean, that's just a level of trust. I think if you're working towards it, I knew when I went in there's an exit strategy. I think most of our customers accept that as well. That's just the way of the world. Where that exit strategy leads us, it's okay. We have a plan. That plan is bought in, and that plan will continue each year. So even if the exit is in 2016 or 17, we still have a 5-year plan. So that 5-year plan becomes part of the sale process. So no, it doesn't worry me. I mean, I would say in previous experiences with the companies that it has worried me, because you never know when it's going to happen. It's a gotcha. And it's very difficult to manage a company on a mid-term basis when you don't know when the bar is going to drop.
Now, Lou, you come at this from a slightly different angle because you were the founder as opposed to somebody who came in as management later. Is your thinking the same or different?
I think for the most part, the big concern is to not only deliver good service, but obviously share value. In our scenario, I think if your strategy is correct, in my line of work, if the strategy CRO is a little different, but if the strategy is correct and the stars are aligned, you know, in our scenario, we had people knocking on our doors. We didn't look, we didn't go out, because we consummated the marriage in September 2011, and we were out in 18 months. So that's a pretty quick turnaround. And but there were people at the door because they liked the strategy, and I think that's what the timing is, what you're looking for.
If I could just add, where we've had issues, and certainly not in the case of AIM Health, is where the CEO knows that they're typically an employee as opposed to a shareholder and founder, and as you're exiting, they know they're going to be left behind with the new owner. So that gives rise to a divergence of interests. And so the better relationship you have and the better the understanding between the two parties are, the smoother it will go. But there's clearly, at the end of the hold period, a divergence of interest between a remaining CEO who wants to do well economically, hold some in his hip pocket for the new ownership so he's fast out of the gate, and you as an exiting shareholder whose role is to maximize value.
Do you want to add anything? So we're down to a couple minutes before we're going to open it up to Q&A, but I wanted to ask our managers whether they wanted to, if they could share some insight for investors in the audience in terms of what they should be looking for from you guys. What kind of returns, what kind of other factors would you suggest that people consider when they consider an investment with you guys? Anthony, you want to start?
I guess it's a given that if you're considering investing behind any manager, whether private equity or anybody else you've heard from today, it's a given that you find the current returns that are being presented to you as compelling. So the returns that have been earned to date have to have been compelling, and that's probably the starting point. So once we get beyond that, I think there's 3 things that you would look at in a private equity fund, and I'm sure Jeff has a couple more. But the first, I think, would be team continuity, because that's the only way by which you can judge whether or not the investment style is embedded within the culture of the company, and whether or not the successes and the failures have become part of the DNA of the group, and that exists at all levels. And I think that's very, very important. Secondarily, an analysis whereby, and you can ask for this because we're all asked for it when people look to invest, which is an analysis of investment attribution, which will give you a sense of whom within the group has done what, who found the deal, who sat on the board, who provided what value add by each investment the fund has made, and make sure that those people are still at the firm to the extent those were the highest returning investments that were made by those firms. So it gets kind of high level. Have the returns been good? Is the team still intact? Take it down a level. Who actually did what in those firms? And then I think, as critically, I mentioned earlier that in my view at least, the PE market has matured a lot in the last 10, 20 years certainly. It's become a lot more commoditized for generic players. And so I think you have to do some work to find out whether or not the group you're looking at has the ability to add true operational value to the business that they've invested in or outright bought. Because the days of buying a business at a relatively low multiple, applying relatively high leverage so you end up with a pretty small equity box, and generating a financial return 5 years later simply by doing that are gone. So the multiples are higher, the debt leverage is lower, the equity box is bigger, and that just means that at the end of the day, there has to be a genuine knowledge and track record in working with guys like Chris or our management teams in finding non-obvious revenue growth, seeing value that isn't necessarily always apparent to the naked eye, developing strategies for improving margin, having true ability to seek out and then more importantly integrate an acquisition that the company does, implement IT that gives better data to the hands of the managers to allow them to make decisions that's typically non-existent in entrepreneurial companies that we buy. And then finally just making the network capability, the Rolodex of Kilmer has to be available to the guys that are running our companies such that they can run a 6 degrees of separation, connecting anybody at Kilmer with anybody that they may want to get to in the outside world, be it a supplier, a customer, a competitor, what have you, helping them connect in areas that they may not otherwise be able to connect themselves.
Jeff?
I would agree with everything Anthony said and add a few. Just as we look at the people when we make investments in the investee companies, I think as an investor or a private investor looking at a private equity manager, you really got to look at the people, the track record that exists, and as Anthony said, attribution, with a special look at who the second tier of professionals are in those businesses, because chances are they're a big part of the driving force to go out and find the deals, the companies that we're investing in. I think also one should look at the adherence to their core strategy. We've seen a lot of our peers in Canada and the US succumb to strategy drift. They raise bigger and bigger pools, and it becomes harder and harder for them to find opportunities in their areas of core specialty. And it's all about specialization these days. I think the generalists in our sector are having a much tougher time because they can't add the value that's necessary. As Anthony said, it's not about financial engineering anymore. Everybody's reasonably smart, and that's not what separates the winners from the losers. Certainly in our end of the private equity market, it's about adding value, and it's not rocket science. It's basic, boring, good business and common sense. The other thing I would look to, as an addition to what Anthony said, is that most private equity is geared to an institutional investor base. So one should really make sure that the accommodation for high net worth investors is within the firm. They're reporting typically for institutions. They don't offer the same flexibility for individual investors that some other vehicles might provide. We, over the last 20 plus years, built our franchise servicing the needs of high net worth investors, and I know Anthony and Kilmer have a number of individuals as well, but most don't. So it is a slightly different animal, so it's really critical to make sure that your needs will get serviced. And finally, really, although you may not be able to replicate it, because we can all read a recipe, it doesn't mean we're going to be a cordon bleu chef, but really have a basic understanding of what your manager is going to be doing out there. It's not rocket science. It shouldn't be a black box. It's good basic common sense, and so make sure it makes sense to you.
Terrific, thank you. So we have some time for questions. Would anybody like to ask a question?
Can I make a suggestion?
Don't be shy. Sure.
If you don't have any questions for the private equity guys, which I totally understand, you should ask these guys some questions, because they know stuff that's going on at the forefront of the medical and disease cure field. They know this stuff. This is your chance. These guys know a lot, and I'd go that direction if I were you. So
what is hot, Chris? What should we be investing in? What should we be looking at? What should we be worried about?
Well, I think
what's changed since the mapping of the genome? What's happening?
I think that's the hot area. It's the genome It was been mapped a long while ago. It's the personalized medicine. What does personalized medicine really mean? It doesn't mean that you as an individual could go into your doctor and get a cure for your disease. I mean, what it really means is what's happening already. Asthma currently has been genetically divided into at least 5 different types of disease. So there's 5 different types of asthma. The normal cure rate for a drug in the general population for asthma, diabetes will be about 50% if you're lucky. But if you segment that disease and now you go into you're diagnosed with asthma type 3, there are drugs that are developed for asthma type 3 which will give you a 90% chance. We saw that with Herceptin and breast cancer. If you express that particular gene, your chances of Herceptin working on breast cancer is better than 90%. That becomes personalized medicine. The work that's going on to map the general population, map sections of their genome, will create a huge database. It answers questions like, well, you can have a double copy of a gene that gives you a 60% chance of getting Alzheimer's. You can all have a check for that. 60% chance with those 2 genes. But 40% don't get it and they have those 2 genes. Why? Well, because it's much more complex than you think it is. There's a lot of control genes. There's cofactor genes. You can only find that from a database. You can't find it from a researcher looking at an Alzheimer's genome separately in a lab. You can only go so far. What I think is going to happen in the next 5 to 10 years, there's going to be a lot more work, a lot more data available to actually better understand the diseases and get better drugs. The downside of that is the days of the billion-dollar drug, and people like Glaxo and AstraZeneca and Pfizer have made a lot of money out of inhaled drugs for pulmonary disease. Those days have gone, because if you've just divided a billion-dollar market into 5, that's not $5 billion markets. So the pressure to get drugs onto the market cheaper is what's driving all the changes you see with the pharmaceutical layoffs, the closures, the outsourcing, the move towards changing your fixed costs to variable costs. They have no choice. They've got to reduce the cost. The cost of getting a drug to market is actually about 300 million. The cost of getting it to market with all the failures is anything between 1.5 and 9 billion, depending how you calculate it. So there's got to be more work done up front, better processes, better analysis systems, so you can get the information earlier. So from what used to be called shots on goal, get enough drugs, kick them into humans, one's going to work. It doesn't work, it's too expensive. It's now much more to kill it early. That's the drug, not the patient, do you understand? So to kill it early means get rid of the drug before you spend a lot of money on it. Be very careful where you're targeting that drug. You see an awful lot of the drug development at the moment is on the orphan diseases. Companies like Genzyme, BioMarin, they're going for orphan diseases. It's a stopgap measure, because who can ever say, I'm not going to pay $1,000 a pill to treat an orphan disease? Who's going to say that? They can't. So it's a way of boosting up flagging drug pipelines by getting very high value on low turnover. That's going to change much more, and the human genome will play a large part in that.
Lou, your focus is more frontline medicine. What trends are you seeing?
No, I think along that line, I think the key areas that you're going to see in change, what we've seen in the last 15, 20 years have been the battle between generics and brands, which is what you were alluding to. And it's pretty easy before patents due, the challenge of patent. And most generic companies now and pharma companies are spending more time in costs and money in courts than they are on research. And that's evident by the stats. But I think what you're seeing now with diseases we're living longer and we're getting into complex diseases, which means that there's 3 or 4 or 5 different things superimposed upon each other, which has an incredible impact on the immune system. And the new drugs, the biologics that are coming out, I think that's the direction to go, because you can't replace them with a generic. The biosimilars have yet to be challenged. And some of these drugs are amazing. If you look at things like ulcerative colitis and Crohn's, I've seen patients come in that have tried everything. They're at their last end. They're 6'1", 110 pounds. They come onto this biologic and Remicade, and they do incredible. It's like you just haven't. I've never seen anything like that in 25, 30 years. So the key here then is the generics aren't going to be able to play this role that they did in interfering with what we were alluding to. And so I think biologics, the linking that to proper treatment. Now, governments haven't caught on yet, because the cost is going to be prohibitive. And that also shifts to managing the immune system rather than wait till something happens and then treating it, right? So it addresses different parts of the disease model.
But some of that's funded by the private system as opposed to the public system.
All the research will be funded by the private sector, but the generics won't have an impact on interfering with the profitability of those biologics, which in my mind then more money can go into the research of inventing new biologics and linking it to genome testing and things like that.
I think we have a question over here. Oh, you've got the microphone. I thought you had a question. Any questions? Well, I have one question. Oh, somebody? Shoot.
In your opinion, what drug or innovation do you think is going to be the next game changer?
What was the question?
Chris, do you want to start?
Well, 50% of the world's clinical trials are on oncology drugs. The greatest disease is cancer. Is a breakthrough and able to cure, or well, there's more of an approach to treating cancer, regarding cancer as much more of a like high blood pressure or diabetes. You get it under control. I think the next breakthroughs, there's so much money going into it, so much research with where science is at the moment. I think the next big breakthroughs are going to be in cancer. I don't expect it to be in Alzheimer's, dementia, although a lot of people would like it to be there. It's just too complex a disease.
Well, unfortunately, we're all out of time, so I'd just like to ask you to join me in thanking our panel for a very lively and interesting conversation.
Thank you so very much to you guys, and thank you to all of today's speakers. Just as you go down, I just would love to take a picture and give you a small token of our appreciation. But aside from that, really, ladies and gentlemen, if I could just ask you to give one last round of applause for all the speakers today. I think we had a great lineup, and you know, whenever I attend a conference, I usually, my aspiration is just to walk away with one insight, and I can't even count the number of insights that I've personally gleaned. So I think today you may have experienced a little bit of what a day in the life of Prime Quadrant is. I mean, aside from the time that we spend with our clients, virtually all of our time is meeting, learning about extraordinary managers, operators, and investors. And I've been at this for a few years now, and I literally still come home every single day amazed by how ignorant I was that morning. And, it's at times overwhelming, but it is also humbling and stimulating and exciting, and I think that's, hopefully you felt some of those, shared some of those emotions today. So thank you to everyone for making it happen. Thank you to all the volunteers that have helped out from Mount Sinai. Really appreciate you taking the time to be with us. Thank you to all of the speakers who really took time out of their very, very busy schedules, and we really deeply appreciate it. Thank you to our generous sponsors, without whom we could not have put this program together. For all of our sponsors, just again, a quick piece of housekeeping. We have gifts for you. Again, a small token of our appreciation on the back table to my right, and where Aaron is, and we'd love to see you there in a minute or two. Thank you to our entire professional team, to the event planners, to Rob Klein, to Aaron Lutz and Mount Sinai. And just before we go into the reception, I will ask you for one favor. This is the second year that we are putting on this conference for the public and for investors. And we would love to hear your input. I mean, many of the suggestions that some people made last year, we've incorporated, and really would appreciate your feedback so we can make future years even better. And obviously, we'll send out a survey. If you could provide feedback through that survey, that would be deeply appreciated. So to close, there's just a little, there's an expression I came across recently, which I tend to like and I think is apropos. We all know the pessimist sees the glass as half empty, and the optimist sees the glass as half full. But the investor just adds whiskey, and that seems to make a lot of things better in a lot of situations. So the time has come. I'd like to invite each of you to our Moulton Manager's Reception, right in the, it's called the Manager's Boardroom. There's a scotch tasting, some hors d'oeuvres, and thank you again to each of you for joining us and for making this such a special event.